All right, you sent us this incredible book, and yeah, we're diving straight into it today.
Let's do it.
Our mission really is to crack open its core argument that, well, our economic and financial future isn't just going back to the way things were.
No, exactly.
It's being powerfully reshaped by just a few fundamental, data-driven forces.
That's right. The book really challenges that common view, and it is shared by many experts, many institutions that were headed back to that low growth, low inflation world we saw before 2020.
Right, the sort of pre-COVID baseline.
Yeah. It says these underlying forces make that future highly unlikely.
And it distills these forces down into four key megatrends. Is that the term they use?
Megatrends, exactly. We're talking about technology, especially the potential of
Yeah.
AI, then demographics, globalization, and government debt and deficits.
Okay.
And the book makes a very compelling case that truly understanding how these trends interact is, well, it's absolutely essential for preparing for what's coming next.
Okay, so let's unpack this framework they lay out. The book starts by asking, why do so many people seem to be betting on that status quo return? And it points to something quite human, actually.
It links it directly to what behavioral economists, think Nobel laureate Richard Thaler, call status quo bias.
Ah, right.
It's just our tendency to favor the familiar, to assume things will mostly stay the same, even when there's pretty clear evidence of change coming down the pike. The book argues this bias can really cloud our judgment about significant economic shifts.
So instead of using models that treat these big forces like, I don't know, fixed background noise,
Right, like constants.
the book offers something different. It's dynamic, it's data-driven.
And it's incredibly deep. I mean, they pull in historical data going all the way back to the 1890s.
Wow, why so far back?
Well, to see how past equivalents of these megatrends actually played out. Think about capturing the impact of, say, the Great Depression or the massive debt from World War II.
Hmm.
The diffusion of foundational technologies like electricity and the internal combustion engine. Big shifts in globalization, too. You need that long view.
And here's where it gets, well, really interesting for me. The book's analysis, looking at fluctuations over 3 years or more, it finds that these megatrends they identify explain nearly all of the movement we see in GDP and stock markets.
It's stark, isn't it? Figure A.4 in the book lays this out. It's
Yeah.
a powerful finding. It suggests that while, shorter-term events grab headlines, the medium to long-term direction is overwhelmingly set by these massive supply-side forces.
Okay.
And the book uses a great analogy. These megatrends are like tectonic plates.
Ah, okay, shifting under the surface.
Exactly. They're almost never in perfect balance for long, and when they move, one tends to dominate. They don't just neatly cancel each other out, which is a core reason the book argues against the status quo returning.
Got it. So let's dig into the first of these tectonic plates, technology, and let's focus on AI. The book has a pretty straightforward yet powerful idea about how technology impacts work.
It really boils down to two simple truths. First, technology can automate tasks.
Right.
Think about the old days of manual telephone operators. AT&T eventually automated that away, right? Eliminating tens of thousands of jobs.
Okay, automation. And the second truth.
Technology can augment our work. It can make us more productive, raise the quality, increase the value of what we do.
So not replacing, but helping.
Precisely. The book uses accountants as an example. Computers automated things like data entry for them years ago, yet the number of accounting jobs has actually grown.
Why?
Because the technology augmented their ability to do more complex analysis, simulations, higher value work. The key, the book stresses, is looking at the impact on tasks within jobs, not just jobs disappearing entirely.
That task-based lens seems crucial. So applying it to AI, what does the book see happening over, say, the next 10 to 20 years for specific jobs? Let's take nurses.
Okay, nurses. For them, the book sees AI largely as an augmentation tool, sort of a co-pilot, you could say.
A co-pilot.
It can help with tasks like initial patient triage, monitoring vital signs, maybe improving the flow of patients through a hospital. Economists call that improving allocative efficiency.
Making sure resources go where they're needed most.
You got it. Making sure doctors' time, hospital beds are used effectively. The book estimates this could boost nurse productivity by about 20% by 2035.
That's significant.
It is. And it's a potentially significant help against the pressures of an aging population needing more health care. You see this already in Japan, for example, using robotics to augment care for the elderly.
Interesting. How about financial advisors? Is it a similar story?
Pretty similar, yeah. Mostly augmentation. AI can automate tasks like routine data entry, maybe ensuring compliance checks are done correctly, even drafting parts of a financial plan.
So the grunt work.
Kind of. The book suggests this could save advisors maybe 1 to 2 hours per day.
Wow.
And that time isn't wasted. It frees them up for the highest value activities, things like behavioral coaching, tackling truly complex client situations, deepening relationships.
The human element.
Exactly. It's like the analogy the book uses of the auto assembly line. Automation handled routine tasks, but that allowed workers to shift to new tasks that drastically increased the value and sophistication of the final car.
But it's not just augmentation across the board, right?
Yeah.
The book mentions computer programmers.
Yeah, this is one of the surprising findings highlighted. While many programming tasks are complex, AI is getting incredibly good at certain things, like generating code and testing it.
Uh-huh.
Programmers spend, nearly 45% of their day on those specific programming and testing tasks? And AI could significantly automate parts of that.
So fewer jobs there, potentially.
For some types of traditional programming, the book suggests AI could actually lead to a significant reduction in job prospects. It's not uniform.
So it's a really varied picture across different occupations. I think figures 2.7 and 2.8 lay this out visually.
Exactly. The book's analysis shows that while some jobs have high automation potential for certain tasks, over 60% of occupations will primarily see AI as an augmentation tool.
So the takeaway isn't marginal impact, but it's not, a jobs apocalypse either.
Precisely. It's somewhere in between, and it varies a lot.
And this potential for AI to automate tasks, to boost productivity, that actually plays a crucial role in potentially offsetting one of the other big megatrends, demographics, right?
Absolutely. I mean, as the baby boomer generation retires, workforce growth in the U.S. naturally slows down. It has to.
Sure.
So the book estimates that AI could automate about 20% of tasks across the average U.S. job by 2035. Think of that as automating like 1 day per week.
Okay.
That means the economy could potentially generate significantly more output per worker, helping to maintain economic growth even with fewer people entering the workforce.
The book talks about this using the concept of a J curve for these really transformative technologies like AI. Figure 1.2 shows this, I think.
Yes, it's a useful way to visualize it. We're currently in phase I of the AI J-curve. That's the intense investment phase. Companies are pouring money into R&D, infrastructure, initial deployment.
Right, building the foundation.
Yeah, exactly. The big productivity surge, that's phase 2, comes later. Once the technology is widely adopted across many industries and enables entirely new business models, new services, stuff we can't even fully imagine yet.
Like electricity back in the day. Was that similar?
Perfect example. The book uses the historical diffusion of electricity after the 1904 St. Louis World's Fair. It didn't just make factories run faster, though it did that too.
Right.
It enabled entirely new industries like movie theaters, and it significantly improved quality of life, allowing more reading at night with electric light, which boosted literacy. Big transformative effects beyond just efficiency.
Looking globally, where is this AI capability most concentrated right now, according to the book? Who's leading the charge?
Well, the book has this AI Vibrancy Index. It's detailed in Figure 6.1. It points pretty clearly to the United States and China having a commanding lead right now.
How do they measure that?
It looks at factors like private investment in AI, the volume and impact of AI research papers, the underlying digital infrastructure, things like that.
Okay. And it's interesting that those two countries are also facing their own significant demographic and fiscal challenges.
It is noteworthy, absolutely. That interplay is key.
And the book touches on how AI's potential isn't just about economic efficiency, right? It mentions transformation.
Right. Just as electricity improved things like workplace safety and air quality, things that aren't strictly economic metrics.
Yeah, quality of life stuff.
Exactly. AI has the potential to bring about fundamental shifts in our lives, too. The book speculates about AI's potential impact on health outcomes, for example, potentially reducing deaths from things like accidents, disease, or overdose. Figure 7.2 shows this conceptually. That's transformation beyond just the GDP numbers.
Okay, fascinating stuff on AI. Let's shift gears to the second megatrend, globalization. Now, when we hear this word, our minds often go straight to physical trade ships, containers, factories overseas.
Yeah, the visible stuff.
But the book argues that's not where the real power lies.
That's a really key point they make. While physical trade is, visible and important, the book contends the true engine driving growth from globalization is the exchange of ideas.
Ideas? How so?
Well, innovation is rarely a solitary act, right? It flourishes when ideas from different places, different disciplines, combine and build on each other.
Can you give an example?
Sure. Think about the Wright brothers. Their work on flight was influenced by ideas coming out of France at the time, or, the iPhone.
A classic example.
It's a testament to global idea networks. It uses Bluetooth technology developed in Sweden. It even uses frequency hopping, a concept patented by the actress and inventor Hedy Lamarr years earlier.
So kidding, Hedy Lamarr.
Yep. Ideas flow and combine. And the book actually tries to quantify this flow of ideas using something called the idea multiplier. Figures 3.3 and 3.4 illustrate this metric.
The idea multiplier, what does that track?
It essentially tracks how many future ideas one original idea sparks, on average.
And what does the data from this idea multiplier tell us? Does it matter?
Oh, yeah, it matters. It's statistically linked to productivity growth. The analysis suggests doubling the idea. Multiplier can add about 1.2% to productivity growth.
That's substantial.
It is. And the book notes that this multiplier was relatively stagnant, kind of stuck around 200.1 for years after the global financial crisis, which might help explain some of the weak productivity growth we saw in that period. But now it's surging. It's up to around 400.1.
Doubled. What's driving that surge?
The book attributes it partly to ideas coming from more parts of the world. Think China's rapid rise in scientific research output.
Okay.
But also, importantly, the increasing cross-pollination of ideas across different fields. Things like fintech blending finance and tech, climate tech, environmental science and engineering, or those breakthroughs in drug discovery like mRNA vaccines and CAR-T therapies. That's biology, computing, medicine, all coming together.
It's the combining of previously separate concepts that sparks new things.
Precisely. And the book uses a fascinating historical counterexample to show the risk of, shutting down this exchange. The Ming Dynasty in China. By outlawing ocean travel, they essentially cut themselves off from global idea exchange. The book uses this as a powerful lesson about the economic and innovative cost of turning inward.
A cautionary tale. And on a more immediate topic, the book also tackles a concern that, reversing physical trade deglobalization will cause high inflation in the U.S.
Right, that's a common worry. But the book's analysis, particularly in Figure 3.1, suggests that while there might be some impact, globalization's effect on U.S. inflation has historically been, modest.
Modest. Why?
Primarily because imported physical goods are actually a relatively small percentage of overall consumer spending in the U.S. So while supply chain shifts can definitely cause temporary price spikes.
Like we saw recently.
Exactly. But the book argues that deglobalization of trade isn't likely to be the main driver of persistent high inflation, according to their framework. Other factors are more significant there.
Okay. Let's transition then to the third megatrend, demographics. We often hear that phrase, demographics is destiny, implying that things like population growth, age structure, they automatically dictate economic growth and inflation. The book really challenges this idea head-on.
It directly pushes back, yeah. The book's historical analysis, Figure 4.1, shows this looks at what happened after periods of slowing population growth across many countries and many different eras.
What was the result?
Basically a coin toss. The outcome for economic growth and inflation was equally likely to speed up or slow down. There just isn't a simple deterministic link.
So it's not destiny. The book argues GDP growth follows technology and productivity much more closely than it just follows population numbers.
That's the argument. Figure 4.3 visually demonstrates this pretty well, showing how productivity growth trends align much more closely with GDP growth than population growth does over the long haul.
Okay, so what about aging specifically? That's a big concern.
It is, but the book offers some nuanced points that counter the common fears. First, the idea that older societies are inherently unproductive isn't fully supported by the data. Older workers bring valuable knowledge, experience, and interestingly, aging societies actually tend to invest more in productivity-enhancing capital like industrial robots.
More? Why?
Possibly to offset shrinking workforces. The book compares robot adoption rates in the U.S. to older societies like Germany and Japan, where the rates are significantly higher.
And in the U.S., older Americans are working longer than previous generations anyway, aren't they?
They are, yeah. Due to factors like better health, higher education levels, and also a shift towards jobs that are less physically demanding, more age-friendly.
Okay, so that's productivity. What about spending? Don't older people spend less?
That's the other common assumption the book challenges. Figure 4.5 shows that while the mix of spending certainly changes, you spend more on healthcare, maybe less on physical goods.
Sure, makes sense.
But total lifetime consumption tends to remain relatively constant after about age 30. so it shifts spending patterns. But, according to the book, it has only a modest impact on overall price levels, like inflation or deflation.
So while aging is definitely a challenge, it's not necessarily a growth showstopper or guaranteed cause of deflation everywhere.
Not automatically, no. However, the book does highlight one specific demographic picture as particularly concerning:
Such as?
China. The book notes China's projected population decline is really dramatic. Figure 4.4 shows this starkly, and it's combined with very little immigration.
A double whammy.
Exactly. This creates an unusually significant demographic headwind that, according to the book's analysis, may be difficult for even strong AI-driven productivity gains to fully offset when you look at long-term GDP growth potential. China might be the exception that proves the rule here.
Okay, that's a sobering point on China. All right, let's move to the fourth and final megatrend, government debt and deficits. The book starts this section with a great historical touchstone, Ida May Fuller.
Yes, Ida May Fuller, receiving the very first Social Security check back in 1940.
Why start there?
It's a perfect human illustration of that fundamental link between an aging population and government spending commitments. Ida May lived to be 100.
Wow.
She collected far more in benefits than she ever contributed in payroll taxes. Her story just perfectly highlights the long-term fiscal challenge created by increasing longevity and the rising costs of these age-related programs like Social Security and Medicare.
And figure 5.2 in the book shows the history of U.S. debt to GDP spiking during major crises, and now back near World War II levels. But the book argues focusing only on this ratio can be misleading.
Very much so. It calls debt to GDP a flawed, often cited metric. It's like judging a household's financial health solely by its credit card balance without looking at income or assets or anything else.
Yeah.
And the book's analysis in Figure 5.3 shows that a high debt to GDP ratio hasn't historically been a reliable predictor of poor economic growth or high inflation.
The post-WWII boom being the classic example.
Exactly. Debt was over 110% of GDP, but the economy boomed, so the ratio itself isn't the full story.
So what does the book say we should focus on then?
It argues the deficit, the annual flow of spending exceeding revenue, is more important, particularly over time. And within deficits, the crucial distinction is structural deficits.
Structural deficits, what are those exactly?
These are the persistent deficits that aren't just due to recessions or temporary spending like wars. They're kind of built into the system, largely driven by that rising age-related entitlement spending we just talked about. Figures 5.4 and 8.2 show these structural deficits have increased significantly since the global financial crisis.
And the book uses historical examples to show why these structural deficits matter more than just the total debt level.
Yes, the 1970s are a key lesson. Debt to GDP wasn't particularly high back then, relatively speaking. But structural deficits were high, partly due to Great Society programs kicking in, combined with a slow productivity growth environment. The book's framework estimates these structural deficits contributed significantly, about 32%, according to Figure 5.6, to the Great Inflation and that stagflationary environment.
How? How does a structural deficit contribute to inflation or stagflation?
By potentially crowding out private investment over time.
Crowding out.
Yeah. When the government persistently spends more than it takes in, it has to borrow heavily year after year. This increased demand for borrowing can push up interest rates over time, making it more expensive for private companies to borrow money for investment, new factories, R&D, equipment.
Less private investment means slower future growth potential.
Exactly. That's the risk. And the book contrasts that 70s period with the 1990s.
Right. What happened then?
Well, in the 90s, the tech boom actually helped improve structural deficits temporarily. Faster growth meant more tax revenue.
Oh, okay.
So the lesson is that a low overall debt ratio doesn't guarantee fiscal health if you have large, persistent structural deficits humming along underneath. Those can drain capital and potentially slow growth over the long term. Ida May Fuller's longevity really embodies the long-term nature of this structural fiscal challenge.
Okay, this is great. We've unpacked the four forces: AI tech, globalization ideas, demographics, not destiny mostly, and deficits. Structural ones matter. So let's pull these four forces together now. The book's core thesis, the central conflict shaping the future, is described as a tug-of-war.
Yes, a monumental tug-of-war, primarily between two of these really powerful forces. The potential for AI-driven transformation on one side,
A positive force.
and the headwind of age-driven fiscal deficits on the other. Figures 5.6 and 7.1 really depict this central struggle.
And based on its framework, Analyzing how these forces might play out, the book presents two most probable scenarios for where this tug-of-war leads us by, say, 2035.
That's right. Scenario one, which the book views as the more likely outcome, giving it maybe 60–70% odds, is titled AI Transforms, Productivity Surges. You can see this in figure 7.3.
Okay, what does that future look like?
This is where AI really proves to be that truly transformative general-purpose technology we talked about. It leads to a significant widespread boost in productivity and, consequently, faster overall economic growth.
And the deficits in that scenario.
They're less problematic. The inflationary pressure from deficits is dampened because the economy is growing faster, generating more revenue. This scenario generally supports higher valuations for assets like stocks. It's the optimistic path.
Okay, 60–70% chance. What's the second, less likely but still significant scenario?
It's called AI Disappoints, Deficits Drag. Figure 7.2 maps this out. The book puts the odds here at maybe 30–40%.
AI disappoints, so AI doesn't live up to the hype.
Or its impact is just more incremental, or maybe much slower to diffuse across the economy than hoped. In this future, the rising fiscal deficits and those demographic pressures become the dominant forces.
And the outcome?
Potentially a blend of stagnation and inflation, what some might call stagflation. Slower growth, maybe higher inflation, and potentially a really challenging period, maybe even a lost decade for stock market returns.
So while the odds favor the transformative AI scenario, it's clearly not a sure thing. There's a real chance the deficits win the tug-of-war.
Absolutely. And the book argues this battle between these two paths is the most significant economic question facing us, much more consequential than just assuming a return to the past.
And other outcomes, like just going back to the pre-2020 status quo.
The framework assigns much lower probabilities to those. As you can see in figure 7.4, the tug-of-war is the main event.
This leads us then to the big practical question. What does all this mean for you, the listener, when it comes to investing your money? The book connects these economic scenarios back to investment strategy, even referencing a conversation with Jack Bogle about needing a solid framework for long-run returns.
Right. It takes Bogle's foundational principles, having clear goals, diversification, keeping costs low, and maintaining discipline, and says they remain absolutely essential. But it particularly emphasizes discipline as crucial for navigating the uncertainty created by this megatrend tug-of-war. Don't get whipsawed by short-term noise.
And it prompts us to maybe question some traditional investment ideas, some dogma that might not hold up as well in this new environment.
It does, like the assumption that in a tech-driven future, you should only focus on today's leading growth stocks, the big tech names.
Yeah, seems intuitive.
But the book presents research, like that in figure 9.4, suggesting that during the widespread diffusion of past general-purpose technologies, think electricity, railroads' value stocks often perform surprisingly well.
Value stocks?
Yeah.
Really? Why do?
Well, as the new technology spreads across all industries, it spurs creative destruction. New, more efficient companies or methods replace older ones, even disrupting the early tech leaders. Competition intensifies. And value stocks, maybe in companies successfully applying the new tech to older industries, can become relative winners.
That's a really interesting twist. So value isn't just old economy. It can be old economy successfully using new tech.
Exactly, or new competitors emerging. The book also challenges the idea that a standard 60-40 U.S. portfolio is the only rational approach.
The classic benchmark.
It's a great benchmark, absolutely. But the book suggests that being aware of the megatrends and these potential scenarios allows for moderate, valuation-aware deviations or tilts in your allocation to manage the different risks.
And it really bangs the drum for global diversification, too.
Oh, strongly. Using some compelling research, like their needles in the haystack analysis in figure 10.2, the book shows that the few, often unexpected, winning stocks that generate the majority of long-term wealth globally are scattered across different countries.
Right, you can't predict where the next big winner will come from.
Exactly. So it strongly underscores the importance of diversifying beyond just the U.S. market to capture those dispersed opportunities and also potential AI transformations happening elsewhere while hedging U.S.-specific risks.
Okay, this all leads to the book's proposed approach, what they call a megatrends-aware portfolio. Tables 9.1 and 9.2 outline this. What's the core idea?
It's not about making a high-stakes bet on one future scenario. It's not predicting whether AI wins or deficits win. It's about building a diversified, balanced strategy that prepares you reasonably well for the two most probable futures identified by the framework that's the AI transforms world and the deficits drag world.
Hedging your bets, in a sense, but based on the most likely outcomes. So what are the key moderate tilts it suggests considering?
Based on balancing the potential risks and rewards of those two scenarios, the book suggests potentially increasing allocation, moderately, to value stocks.
Why value again?
Partly as that hedge against current tech leaders facing creative destruction if AI diffuses broadly, but also because value stocks may be less sensitive to the interest rate risks in the deficits drag scenario.
Yeah.
And the other tilt is increasing allocation to non-US equities.
For diversification and capturing global growth.
Exactly. Diversification, capturing potential global AI benefits, and avoiding being solely exposed to potential US-specific fiscal headwinds if that scenario plays out.
The book uses the Battle of the Nile analogy here, which is quite vivid. Nelson versus the French.
It is a great analogy. French Admiral Brueys assumed one status quo future that the British fleet would attack conventionally head-on. He lined his ships up accordingly and was defeated.
Okay.
British Admiral Nelson, however, didn't assume. He divided his fleet and attacked along two unexpected paths simultaneously, preparing for different possibilities. He adapted and won.
So the lesson for investors is,
Instead of structuring your portfolio for just one expected future, even the most likely one, think about preparing reasonably well for the two most probable outcomes. The Megatrends-aware portfolio, with those tilts, is designed to significantly reduce the downside risk you'd face in that less favorable deficits drag scenario,
protect yourself if things go badly.
while still maintaining similar expected overall returns compared to a standard diversified portfolio if things go well. It's about resilience across the most likely futures.
So bringing it all together then, the core takeaway from this book, this deep dive, is that the future probably isn't just a linear extension of the recent past. It's not status quo.
No, it's likely to be fundamentally shaped by the complex, sometimes unpredictable, but ultimately analyzable interplay of these powerful megatrends, with the primary struggle being that tug-of-war between AI-driven transformation and the headwind of fiscal deficits.
And while that future is definitely uncertain, the book's framework, combined with those time-tested investment principles like diversification and especially discipline, offers a clear path to preparing for the most probable outcomes, rather than just, hoping for the best or assuming the past repeats.
It really provides a much-needed lens, I think, to look through the fog of uncertainty that's out there right now.
Yeah. The book finishes with that story of Skagway, Alaska, from its preface, reminding us that places, like economies, evolve dramatically based on shifting forces. Skagway went from a wild gold rush town to a cruise ship destination. Completely different drivers.
It's a great closing thought. Just like Skagway was shaped by the forces of the gold rush and then tourism, our economy and our lives will also be reshaped by these megatrends: AI, demographics, globalization, deficits. The rugged seas of uncertainty, as the Tlingit name for Skagway apparently suggests, will remain.
Always uncertainty.
Always. But understanding these underlying forces, these currents, allows you perhaps to face the future not with fear, but maybe with a bit more resolve and certainly a more informed plan for navigating the changes ahead.
It really does give you a lot to think about. As you, listening, reflect on this deep dive into AI, demographics, globalization, and government debt.
Yeah.
What aspects of this potential tug-of-war, this battle between transformation and deficit, stand out most to you as you gaze towards your own financial horizon?